perversely, does this make you positive on any of these stocks because it means they are cutting back expenses quite dramatically?
I think it's the early signs of the time to get positive. Clearly, it's been a really tough 22. It's going to be a rough first half of 23. We think there are more job cuts underway. We obviously published this report last night, just this morning. Both Zuora and IAS in tech had over 10% layoffs. So we're going to see more. It's going to continue to weave through the public and private market, probably more so even in the private market in the beginning of next year. So I don't think the pain is over, but I do think the good news is that companies that were running, high growth and no lack of profitability are now switching, and you're seeing investors applaud that. You look at MongoDB and how well the stock did in their focus on profitability. So I think we're in the early stages of this, but I still think we have some more pain to go for tech. First half of the year is going to be a difficult backdrop of demand.
How much of this, though, is correcting the excesses of the previous 2 years? Because it was Hewlett-Packard, I think, when I read about their recent job cuts, they said that they had hired 10,000 people over the previous year, which is like hundreds of people every day. Did companies overexpand?
100% yes. I mean, we're dealing with the tech excess. And I've said this repeatedly, the tech industry is notoriously never in front of the puck. And if you know how to ice skate, you know what I mean. It's just hard. You got to go where the puck is going, and they're always behind. And so I think we're now playing catch up. The pandemic, every tech company got on your show, told all the analysts, hey, this is the new reality. It's not a pull forward. And that all ended up not being true. And so I think all these companies are seeing a pullback in demand. And it doesn't matter if you're in cybersecurity, applications, infrastructure, you're seeing the pullback. And so there's a tremendous amount of excess. And we've looked at, if you take Google, their headcount was up over 25% or close to 25% in the last quarter. They're going to grow high single digit next year per Wall Street estimates. So you can't have these headcount numbers growing faster than revenue. So I think ultimately there's a tremendous amount of excess. I mean, you look at Amazon's headcount, you look across the board. There's not one vendor to single out. They all were guilty, and we're going to see it, at a minimum a freeze, and probably continue to see additional layoffs as we go into 23. That will restore the health of tech. That will restore the margin structures, and it is no longer about just growth. It is about responsible growth and profitability. And the only way you get there, because revenue is fading, the only thing you can control is the bottom line, and so that's headcount.
Brent, let me ask you about what comes next, right? Because we're painting this whole industry, it's all obviously one tech industry with a broad brush, but each individual story here is so different, right? You look at Amazon, that's a story about package deliveries during the pandemic. Facebook is a story about an aging user base, not adapting to new technologies fast enough. You look at Twitter, I mean, that's its own bizarro, surreal universe, right? Each one of these has a different reason for the predicament that it's in. So how do you see them coming out of this series of layoffs? Are they going to come out in a different order or at a different pace? Are we going to rank them differently on the other side of this?
Yeah, I mean, it's a good point. There's tons of microclimates, so we can't take a broad brush, but I think we can take a brush on the overexuberance of tech in the last 2 years post the pandemic. That clearly was in. So I think there's no disputing that. What I think is going to happen coming out of this is there are going to be stronger companies. And one of your guests, Brad at Altimeter, said this, and I think he said this very well. I think we're going to come out of this and realize that we didn't need as many people doing this job. We can be more efficient. Many have talked about Salesforce.com. Do you need as many sales and marketing people there to actually execute on the revenue goal? And I think in many of these companies, you can have 10% less capacity and still deliver on the same revenue number. And that just shows you how much excess there was. I mean, everyone in Silicon Valley knows this, right? That basically, 20% of the developers do 80% of the work. So, do you really need
It's just figuring out which 20% are doing it, though. That's the challenge for management, right?
Yeah. Brent, in all seriousness, what's your favorite stock right now before we let you go?
Into next year, I like Intuit. It's got the exposure to both consumer tax and small business. Really great story in terms of focus on the buyback, and his post this year has had 10 plus years of double digit or single digit returns. 80% of those years have been double digit. So really consistent story would be one name we'd focus on.
All right, into it. Brent, thanks very much. We appreciate it. Brent Thill.